A group of elite entrepreneurs, tailor-made for making American dreams come true. From social media, education, technology, health, commercial lending, financial and insurance services, our elite founders each contributed their knowledge and resources, elevating 9 Fortunes members via training, seminars, and professional knowledge. 9 Fortunes members will be fast started the moment they join. We also provide weekly discussions and seminars focused on creating a revolutionary innovative e-commerce marketing platform. From the collaborative leadership of our top elite leaders, 9 Fortunes will create many million-dollar elite earners in the shortest period of time. These elite earners would be sharing the same platform with 9 Fortunes founders, sharing the new era of revolutionary innovative marketing platform.
Hello, everyone. How's everyone doing today? I hope everyone is doing fantastic. Today is another event with 9 Fortune, and we're going to learn a lot from this gentleman. He's been in the industry for many years, carrying a lot of education in the financial sector, has been in the financial sector for many years, and he holds many licenses. He has been a financial advisor in the insurance industry since 2018. He holds a FINRA security license and life health insurance license. So he seeks to establish lifelong professional relationship and trust with clients and works closely with tax legal professionals to provide customer asset management, retirement planning, tax optimization and strategy, and estate planning solution. Previously, he had a successful career as a senior software engineer and tech lead industry in the computer science. He holds 13 US patents for that innovative contribution at work. Jeff received a bachelor in electrical engineer from Shanghai Jingtao University and master in computer science. So he is a very savvy in technology. So we're gonna learn a lot. I'm sure our topic of today is retirement. If you have a piece of paper and a pen, please make your notes, and we're gonna answer every question that you may have at the end of the presentation. Well, without further ado, let's put our hands together and warmly welcome Mr. Jeff Lin. Jeff, the stage is yours. Your mic is off, Jeff.
Hello, can you hear me?
Yeah, now we can hear you.
Can you see my screen? Am I sharing my screen? About now?
Yes, we see it.
Oh, why I cannot see myself? Anyway, never mind. Yeah, let's get started. So, hi, my name is Jeff. So today's topic is about retirement planning and annuities, right? So this is my resume. So Vanny already briefly introduced myself. So this is today's agenda. So I'm gonna talk about retirement planning 101 and what's the 3 biggest challenges facing retirees nowadays, and what's the problems with the existing solutions. And the fourth will be our philosophy and our approaches to solve those problems. And then I will give you guys 3 case studies and the latest product updates. Yeah, so let's get started. So when we talk about retirement, there's actually 2 lifestyle of the retirement. So when I talk about retirement, I really wanna not on the left side, like continue work in the Costco or like live at home alone as a couch potato. So I really looking for a worry-free retirement so that I no longer need to work and have enough freedom and being healthy, and also have enough money to live my dream life with my loved one, or have some time to develop some hobbies. So hope we are on the same page in this in the audience, right? So those are the retirement life we are hoping to live, right? After like 30 or 40 years of hard working, though it's like something we deserved. So like how can we achieve this goal? So this is like the major topic of this talk. So when you look at retirement planning, so the big picture is actually you can divide your money-wise, you can divide it into two phases. First is the accumulation phase. The second is the distribution phase. So usually people think about retirement when they like after they work for like about 10 years in the job market, and being settled down, raising, having bought a house and raising kids. So at around the age of 35, that's when typically people started thinking about how many years we still need to work and when we can retire, right? In the US, retirement is really about like, it's all like a freedom country, right? It's really about your own decision. And what makes most people's decision on the retirement age is probably how much money you already saved during this accumulation phase, right? So yeah, let's say we're talking about retirement around age 60. So then the question will be, how long will my money last during this distributing period, right? So how much money I need to save to this point that is able to last over the entire retirement years of the rest of the life, right? So I like to draw some analogy of this two phase, like to mountain climbing. So there's the highest mountain in the world is Mount Everest. There's an anecdote like saying that more people have died descending the Everest rather than climbing all the way to the summit. So part of the reason is that maybe people are so focused on reaching their goal on the accumulation or the climbing up phases, right? So, but they fail to plan for what they will do or should be prepared afterwards, right? So yeah, so if we apply this analogy to retirement planning, it's kind of similar. Oftentimes people are more focused and more prepared for saving for retirement and reach the retirement saving goal, but failed to plan ahead for what they will encounter once they actually reach that goal and actually retire. I mean, like the current situation, the world has been changing quite a lot. The situation has changed. So during retirement, you no longer no longer work anymore. That means no new income comes in. So have to live off on your investment or savings. So what if the market, there's a big bear market downturn that eats up your lifetime savings by 20% in 3 months? So are you mentally prepared or financially prepared for this kind of situation? I mean, this is not a real scenario. We've been experiencing exactly 20% down like in 2 times in the last 3 years, right? So that's, I'm gonna, in this topic, more focus on the distribution phase and what's the challenge and what has usually been ignored by mid-age or young folks during this accumulation phase, right? So yeah, I'm going to talk about 3 biggest challenges during this distribution or retirement phase, right? So the first one is the longevity, meaning that the life expectancy are longer and longer. People are the medical condition is good in the US. People live longer than their parents or grandparents do nowadays. And the other is the market risk. This global economy, the market, usually the economy doing well, but there's a lot of like unforeseen risks, like black swan, like last time we have the COVID. And before that, there's this subprime mortgage crisis. Like the economy or the finance market just becomes so complicated. No one could know exactly what will happen in the market, like in the future, right? So there's a growing market risk that will probably affect your retirement savings. And the third is the increasing cost of living. Like the last year's biggest headline is like the US inflation reached above 8%. We've been experiencing the highest inflation rate since 80s, so in last 40 years. So yeah, so this is raised a lot of concern for most of people. So as we are live longer, and this is a real threat, like the inflation gonna eat up a lot of your savings if you don't keep investing, right? So yeah, that's a real concern for a lot of people. So I'm gonna go in detail about all three challenges one by one. So first is the life expectancy, and So in the US, we are talking about on average right now. It's life expectancy is 78. So guys usually live like 5 years short than ladies. But when you kind of break that down into different ethnic group, you can see this also varies a lot. So like on the above average, you can see this Latino American and Asian American. So the Asian American actually have the longest life expectancy, averaging 86.5 years old. And if you are Asian, happen to be an Asian American lady, so the current life expectancy is around 90 years old. Like meaning like on average, you could live up to 90 years old, right? So let's go back to the previous scenario. So think about you starting to prepare retirement in your early 30s, and actually retire, the goal is in early 60s. So that means you have 25 to 30 years preparing or saving for the retirement, and another 25 to 30 years in the distribution phase for the actual retirement. So the question is, how much money do you need to save at this point that you can say, oh, I'm done, I don't need to work anymore? So it really depends on your lifestyle, right? So I'll just give it one example. Say you have and using some rule of thumb calculation, say you have at this point, like age 60, you have like 2 million retirement funds. Then you strictly follow a 5% withdrawal rule. So annual retirement income we're talking about is like 2 million times 5%, that's like 100K a year. But probably not bad in today's standard, right? But like the question is, did you consider the tax on it? And how long will that last, right? Will it last all the way to 30 years? Or what if you are like live longer than the average, like you live to 95 or 100 years old, so it's probably going to be 40 years, right? So actually, then I'm going to talk about the second topic, is the market. How long will that last? It really depends on if your money is all invested in the stock or bond market. So it's really depend on how the market performed during your retirement age. So you see, if it's in the accumulation phase, this chart is showing two sequence of return for your money. So during accumulation phase, people just doing dollar cost averaging, like consistent invest every year, every month of a percentage of their paycheck into this retirement saving account, right? So if the market kind of in the red line, if the market goes up in the initial couple years and then go down in the last 3 years in a row, and versus in the black line, the market first, I kind of just reversed the order of the return sequence. So the market actually goes down for 3 years in a row at first, then it's kind of picking up. So if it's in the accumulation phase, because you're just continuously saving into it, you're not like taking any withdrawals. So the sequence of the return doesn't really actually matter. So you will end up reach the same point, like starting with 100K and reach like around 600K in this case, right? But things are different in the distribution phase, which is called reverse dollar cost averaging effect, meaning that you have to live off on your lifetime savings. So you need to take periodically withdraw from this saving account. So let's still take like 5% annual withdrawal as an example. So if you retire, you're lucky, and right after retire, you are in the bull market, like this scenario. So that money can last a long time, like over 25 years, you still have like more money than you originally started. But what if you are unlucky? Right after you're retired, you decide to retire, the market kind of crashed 3 years in a row, then it can gradually pick up. But because you have to take out income for retirement cost of living from this, so you were never able to catch up with when the market actually picks up. So in the end, your account B, the black line, only lasts for 13 years, not like what you would expect that could last more than 25 years, right? So yeah, so that's the risk of the market returns, or the market risk on your retirement planning. So no one could like predict the future, right? So no one know like next 2 or 3 years the market gonna go up or go down. So if you are unlucky, so you probably at this time you're running out of money much sooner than you expected. Then what's the solution? You need to go back to work again, to saving again. So that's very highly undesired scenario. So we don't want to retirement by chance or retirement by the mood of the market, right? We want to 100% worry-free retirement. So yeah, so that tells you putting all your money in the market and hoping it's doing well is probably not a good idea, especially during your when you're close to retirement or during this redistribution phase, right? So yeah, so let me take a real example, like from if you retire on 1972 and put a traditional wisdom like a bond and stock portfolio working for you. So and you take a different percentage of withdrawal annually. So if you take 10% withdrawal, it only lasts for 9 years. 6% will last 17 years, and 5% actually only lasts for 24 years. So that's barely enough to last for the entire lifespan of your retirement age, especially considering the people are living longer and longer. So only you have to be, in this case, you have to be super conservative, only because you don't know actually how long you're gonna live. So you probably only want to take 4% or even 3% of your retirement saving annually, to hopefully that could last forever. So yeah, so it's like this is probably not a good idea because what's the trade-off of taking only 4%, meaning that you need to lower your living standard, right? So what if we have some product that can give you more than 5% a year without worry about living out of money? So I think that's highly desired, right? Yeah, so the third challenge is the increasing cost of living. So I'm drawing this graph, like this figure is actually showing what most people are actually having in mind about their retirement financial planning. So they think, oh, probably I will just live up to 80 years old and like my parents, and I just need 100K a year. So that's gonna be enough, right? But the reality is you might need much more than you expected. The first is longevity. There's actually a decent probability that we could live up to, you and or your spouse can live up to 100 years old, right? Because the developing healthcare technology, right? And also we are facing very high inflation, especially in this country. Well, products like commodities, those are kind of stay low in inflation numbers, but the labor cost, the medical and health insurance and the service cost, they are usually much higher than the average the inflation rate. So I would just, in this graph, I would just put in 4% because most people after they retire, a lot of the costs are in the, no longer in the buying products like cars or TVs. So usually it's in service area where the inflation is high. So if I put 4% in the number, so the 100K at your 60s might grow all the way to 450K when you're turning 100 years old, right? So yeah, that's something that people usually don't understand because it's grow exponentially. They start low, but it will go to a very large number over the time. So yeah, I just want to visualize and to raise the awareness of the real risk of increasing cost of living combined with the longevity, and that means you need to save a lot more than you probably expected to get actually retired, right? So yeah, otherwise you have to lower standard of living and probably go back to the working force. It's not a desired solution. So then I'm going to talk about the traditional source of retirement income, right? So originally, like back in the old days, like you can think about retirement as like a stool. There's a company pensions supporting the retirement funds, and also like the Social Security, federal Social Security benefits that we all pay in the Social FICA tax in. And then this personal savings as always, right? But you see, there's a cracking on two of the legs of the stool. So actually, like the company pension become rare in the last 30 or 40 years. Nowadays, only public government workers or employees still have pension. People working in the private sector, that's like something that a lot of young folks never heard of even, right? Yeah, so over the term, like since 1980s and 90s, the companies are kind of shifting from this pension or called defined benefit plan, meaning that if you work for a company for like 30 years, they will guarantee to give you 80% of your highest income for all the way down your retirement ages, as long as you live. So that's called defined benefit plan. So the company is shifting from this because this is a big burden on the company side. So they're shifting from the DB plan to DC plan, which are our, nowadays are like 401ks. Company just do some contribution match, and the rest are you are pretty much on your own to manage the invest the personal saving for the retirement. And also the Social Security is not doing pretty well as well. So I'll go into a little bit details in later. So actually, you can see nowadays the stool is tilting very heavily to rely on the personal savings. But well, that put challenge on every Americans, right? So usually people are not well educated in financial knowledge, and also they don't have the mentality to deal with the market turbulence nowadays. So they are not really well prepared to in charge of their retirement life on their retirement financial life on their own. So usually most of the time people will tend to make wrong decisions during market drawdown or bear markets, because of the fear of losing money. So, but those decisions will usually have a very disastrous impact on the lifetime retirement savings of people, right? So yeah. This is talking about the shifting from the DB plan to DC plans, and now we can see this is become a bigger chunk of money that we are like responsible for. And when we talk about those two are used to be like big, which is kind of nice because it gives you a protected lifetime income. Both Social Security and the pension will last as long as you live, right? So, but those are shrinking a lot nowadays, right? So yeah, so the pension is probably most people don't have it. So, and the Social Security is running in deficits, right? So yeah, some numbers on the Social Security benefit side. So actually, we are starting to run deficit on Social Security benefit because the baby boomer are starting to get retired, and the working to retirement ratio is kind of growing to be lower and lower. So we're expecting we're still there's some savings in the federal Social Security fund, but we are expecting to deplete the whole Social Security trust fund in 2034. That's like another 11 years later, right? So what will happen then? So yeah, that's a good question. So the Peterson Foundation actually projects after 2034, they're gonna be, if nothing changes, government doesn't raise tax or delay the retirement age, so there will be a 23% cut on the Social Security benefit. So that's not that reliable, especially for folks in their 30s or 40s, right? So then I'm talking about like typical how we challenges in managing the 401k and IRA by ourselves, right? So typically, if you don't do anything, by default you will your employer will give you a 401k, which is invest in a target fund. So this is how it works. So this is a Vanguard target fund. So it will kind of change the investment portfolio mechanically based on your target retirement date. So when you are like young and far away from retirement, so 10% will be in the fixed income, meaning US and the international bond, and 90% will be invested in the stock market, right? And then when you are like 25 years close to retirement date, so this percentage will the percentage of fixed income will grow, while the percentage of the equity will decrease, right? So when you reach retirement, the end result will be like a 70% bond portfolio plus 30% of the stock market portfolio. Well, the challenge is this is kind of mechanically doing things. So it doesn't look just based on a simple target date of your target retirement age. It doesn't take any market condition or anything into that. So it probably could easily when it shrink the stock market percentage. Maybe it's in a bear market, so you're kind of cutting loss and never have time to rebound, right? So it's not ideal. It's kind of mechanics. So let's say we just have this. This is probably most of people have if you don't pay attention to your 401k. So let's see how it works. Like those are two typical portfolio that you get invested in the target fund. So one is the Vanguard Total Stock Market ETF, the other is Total Bond Market ETF. So let's see how it performed in 2022, last year, right? So actually, like last year is kind of special. So because the rate of interest rate and the Fed tightening all over the place and raising high inflation. So actually, the bond and the stock market goes down along with each other. So the bond is the return, year-to-date return is minus 11%, and the stock market is also down 14%, right? So yeah, so that's we're gonna have a big impact on your retirement saving in your 401k. So if you log into your 401k, you check the performance, it's probably not look good last year. So let me take an example of the Vanguard Target Retirement 2040 fund, meaning you're gonna retire in 2040. So the last year, the return is actually negative 17%, right? So which means if let's say you have 2 million retirement fund in the account, you will face a loss of or drawdown of your value about 340K just in a year. So think about this, like, are you prepared for such a big loss in your account? And then there's follow-up questions. How about this year? How about 2003? There's a lot of people and the financial analysts and big banks are projecting like there's a high chance of recession this year. So does the market already bottom yet, or is there still more room to go? Yeah, probably no one knows, but you probably, if you have 2 million, already lose 340K, you probably get worried about this, right? And the next question is, what if 2008 happened again? So probably not this year, but during your 30-year retirement age, probably you're gonna face a big financial crisis at some point of time. So if all your money are in the market, are you prepared for a big crisis like 2008, right? So yeah, let me try to summarize. So during the distribution phase, we'll talk about the longevity risk, the market risk on your retirement portfolio, and the increasing cost of living of your over the 30 years of your retirement age due to inflation. So then what's the solutions? So like, actually, those are not something I cooked up. Those are like based on the stats. So 62% of Americans say that it's really important to have some retirement saving in financial products that can protect it from loss, right? And 75% of Americans worry about the rising cost of living that will affect their retirement plan. And 76% of Americans saying, actually, they value a guaranteed lifetime income option, such as like the old days pensions. Nowadays, it's called annuity. It's actually a personal pension provided by the insurance company to ease their inflation and market risk worries during their retirement age. Yeah. So yeah, this is an interesting analogy. So we have car insurance, home insurance, health insurance, but what about the retirement income insurance, right? So that's actually, there is a very good solution, which is called annuity, that can provide protected lifetime income, right? So yeah, so the takeaway, if you just want to take away one thing in this talk, is like during the retirement distribution phase, income is really the key. It doesn't matter how much money or how good your investment record is, but when we talk about retirement planning, income is the really key. So because you have to have enough income no matter what the market condition or the inflation number is, right? Because you have to live on your income during your retirement age. So yeah, then go to our solutions. So what if there is a financial vehicle that can provide and solve all three of the problems? So they can provide, what if it can provide lifetime income that you cannot outlive, right? What if it have zero exposure to market risk? Even during 2008, you don't lose any money because even if the market is down like 50%. And it can also provide a annual income that kind of raise over the years so that it can keep up with the high inflation that we are facing right now. So yeah, that product is actually called fixed index annuity. So I'm gonna talk more about it in the second half of the talk. So yeah, let's first go to some big picture. So what's our philosophy for worry-free retirement? It's actually, you can divide your retirement planning, income planning or needs into three categories, like a pyramid. On the bottom, it's your basic needs like food, shelter, clothes, healthcare, and cars, transit, traveling, or those things. And then those are your wants. So some things you could nice to have. It's not basic needs like travel around the world, have some parties with friends and eating out once in a while. Right, so those are the wants, like for a comfortable, desired retirement life. Then there's your wishes. You want to probably do some charity donations or support your grandkids or some poor relatives, whatever you want. So those are the wishes, right? So yeah, so but what are the problems that we are facing right now? So the protected lifetime income is shrinking. Like I said, no more pension, social security benefit are shrinking. So it's not even enough to cover the basic needs. So there's a serious security gap for the retirement income planning, right? So our philosophy is actually a hybrid solution. So we want to bump up your protected lifetime income to cover most 100% of your needs and somewhat like half of your wants, right? So this will be protected by the solution we provide. And then you could still have your personal saving, your 401k or IRA stay in the market, because over the time, market kind of give you good, decent returns if you don't do something funky to it. So yeah, so that will be called probable income, right? So actually, so then it's a hybrid solution. So your personal saving plan won't go away; it's still there, but you really need this fixed index annuity to come to fill in the gap of the protected lifetime income, right? To fill in the needs and some of the wants. Yeah, so it's a combination of those two will give you a worry-free retirement life financially, right? So the goal, the solution is actually when the market is doing well, don't be too complacent, but think about the downturn and the retirement planning in the distribution phase, and convert some of a percentage of your personal savings into annuities, so that you can have a guaranteed lifetime income that can last for life, right? So what's a good time and what's the percentage? You really need to sit down, but every family is different. So you really need to sit down with a financial advisor to talk about your life and your plans and what is a customized solution for your retirement planning, right? So yeah, don't hesitate to add my WeChat so I can give you more personalized advice one-on-one. So yeah, then let's go a little bit in deep about the fixed annuity products on the market, right? So we're talking about two sources of money can be put into the FIAs. So one is your qualified money, like your 401k, IRA, Roth IRAs, right, or 403bs. Another is your non-qualified money. It's basically your after-tax cash savings or stock investment in the brokerage account. And there is actually two types of product for a fixed index annuity. One is more traditional, it's like income driven. So it provides tax deferred growth, downside protection, right? So that's good. And also the key selling point is this lifetime income that you can never live out. So the target audience for this type of product is usually people are in their 40s and 50s and planning to have a lifetime retirement income, right? And the other product is more flexible and it's kind of a new trend. It's actually you have those two as well, but you don't need to turn it into a lifetime income, but you can it's just like a regular IRA or 401k with downside protection, right? So you never worry about losing your principals. And when you want to use it, you can do flexible withdrawal, or you can even do a lump sum withdrawal, or you can like roll it over to another annuity or another IRA account in the future, right? So the target of audience for this kind of product is really anyone who has a lump sum of amount of money that they hope to save for the retirement, like a supplement retirement fund, and or anyone who has recently changed employer, who is looking for a more safe and optimized place to manage his 401k from the old employers, right? So let's talk about like how can FIA reach the downside protection while give you some decent growth. So let's put it on the risk spectrum. So on the left, you have those less risk like money market and CDs, right? On the right, you have those things have more risk, like in the equity market, in mutual fund or individual stocks. So in the middle, you have the fixed annuities, right? So, and this fixed index annuity. Nowadays, because the Fed raised interest rate, you're talking about 4% for CDs right now for like one year or so. And the fixed annuity probably give you 5 to 5.5% if you pick up a good product for guarantee for multiple years. And actually this fixed index annuity is kind of give you even better performance without downside, with 100% downside protection, right? All three of those on the left of this line have downside protection. So this has a higher percentage of return than the CDs and the fixed annuity. So that's why it makes it very popular, because even you are earning 4% or 5.5% on this, but we are talking about a 6.2% inflation rate. So your money still lose buying power over the time if you're being too conservative, right? So on this side, you also have those thing called variable annuity. So your money is kind of your accumulation cash value could facing some, because you're investing in mutual fund usually. So your accumulation value could face some loss, but it has some good thing like protect your pension value or income value from the market risk. So yeah, those are not the focus of this topic of this talk. We are going to focus on the fixed index annuity. So actually, how it works? Actually, it's called like structured products in general. Those you've probably heard about Index Universal Life or RUL. So those are investment-wise, it's using the same mechanism. Basically, the insurance company will put most of your money to buy a corporate bond or MBS or treasury, but basically invest in those fixed income world. And in this case, it's a zero coupon bond, which means give you a discount at the issue time. And when it kind of matures, it will go back to the face value. So that's how it reaches the downside protection, because your downside is protected by the fixed income part of the investment. And then you probably like say you have $1,000, you put 50% into this, and 95%. You put 5% into this, $50, and 95% into the fixed income. So that will grow back to 1,000 over the years, right? And the interesting part is what to do with this 50% or 5%, or you can think of it as like the interest you own or the coupon rate you own on the bond market. So actually, the insurance company nowadays will use that budget to invest into the call option on some index, right? So when you talk about call options market, it's like there's some risky operations, but it also could be very versatile to give you a decent returns if you know how to manage the risk, because you are only invest the interest in the call option, so your principal is safe by this coupon bond yield, right? So if the market kind of goes well, and due to the leverage effect of a call option, so that will magnify your 5% interest into something much higher, like 2 or 3% times higher if the market actually turns out well. So nowadays, so this gives you a good upside potential, because 70% of time the US market is kind of growing in bull market. So over the time you will have higher return than just pure fixed income or CD investment. Yeah, hope that will make sense. So I don't go into too much of the technical details. So this is one example of a index that the insurance company invests in. So the trend is they don't invest in the more volatile like SP 500 or NASDAQ, but they pick some priority index like this. This is called Wisdom's Jeremy Siegel Strategic Value Index, which has a nice track record of compounding 5.3% over the years, over the last 20 years. And plus, it has a high participation rate. Nowadays, it's like 240%. So meaning that over the last 20 years, what you would own is 5.38% times this magnify effect due to the use of the call options, right? So yeah, so I didn't want to go too much detail into the technicals. Let's just go to some straightforward case studies. So I'm giving 3 case study. One is for a age 35 client for an accumulation focused product, looking for rollover his old 401ks to a safer and place for growing. So this is one product called Athene BCA10 2.0. And the second case is a age 40 years old, just want to save an extra money annually for retirement. And there's another product we carry. It's called FNG Prosperity Elite 10. And the third one is a income focused solution. So for a 50 age client planning for lifetime income starting at age 65. So there's another third product that we carry. It's called Allianz ABC. So I will give some real numbers for you guys to check. So what's the results of leveraging those products for retirement planning? So yeah, the first one will be the Allianz, like this example. You roll over, let's say you want to roll over 100K roll over into this product at age 35, right? So there's I pick 3 of the index. You can see current participation rate or the magnifying effect is really high, like in 30% for the Citi Grandmaster Index and 240% for the Shiller Barclay Index and the Jeremy Siegel Wisdom Tree Index. So, and we are talking about like, if you put money into it, how much will you have in the end of the day? So actually it's pretty good based on the hypothesis of the returns based on back testing. So we are looking at putting 100K at age 35. When the client turns 50, you actually have 654K in your account. So this is talking about 6.5-fold growth over the year, only 15 years. So it's pretty decent, probably even doing much better than you invest directly in the stock market, right? So, I mean, is this real number or it's like some fake number? So I actually could go over this a little bit. So let's say we have this wisdom tree index. Let's see how it performed last year, right? So actually I'm pulling out the performance of this index last year. So last year, remember I talked about like the bond market is down, the stock market is down, but this index, because it used some wisdom of the Jeremy Siegel professor, who is a distinguished professor from the Wharton Business School in Pennsylvania University. So it does a lot of good research on how to avoid the market risk and give you a steady performance over the years. So it actually does pretty well last year. So you can see this number last 2022, that actually this index gave you a positive return of 6.7 raw return on this index alone, which is pretty a big surprise, right? So everything go down, how could it be positive? Well, so there's some mechanism or smart algorithm invest into it. So that's the end results. But if you invest in the beginning of the year and plus this high participation rate of 240%, you will actually end up with a positive 16% return on last year. Oh, that's really amazing, right? So everyone is going down, the market is crashing, people are losing money, but your not only your retirement saving is protected, you actually have a fairly decent year last year if you are smart enough to invest in this product, right? Same thing for those 2 index I selected. So they did some back testing on the performance. So those are the for the last 20 years, like picking the best 10 years, average 10 years, and the worst 10 years, right? Given like 100K initial investment for a 10-year period of time. So actually you're looking at the worst 10 years period, though all 3 of them still have like 7%, 12%, and 8% on average, around 9% during the worst 10 years, right? The best 10 years, you're looking at north of 15% annually, right? So it's a pretty decent number. Then go back to the next slides. Next product about the FNG Prosperity Elite product. So this is a case of age 40 client want annual extra saving. So this product is actually pretty good as well. It has a high participation rate for good index as well. So you can see 300 above 300 participation rate. And another good feature about this product is actually a flexible premium fixed index in the annuity, which means you can, rather than doing a lump sum investment, you can invest over a multi-year schedule period. So in this case, this client want to do some planning for better prepare for the retirement. You want to do 10K a year into this product investing, right? So from age 41 to 50, he in total put in 100K, right? 10K a year. So what's the end result when she turns 60? You will have more than 1.1 million at that time, given the historical returns. So yeah, so it's actually pretty good, especially considering you have zero risk losing your money in this investment, right? And the third one is the income focus using the Allianz ABC for a 50 years old client. So this one is actually, I just run it today because they are running a promotion starting from today for an extra 10% bonus for the protected income value. So that means you immediately get 32% of bonus for your protected income value the day you get invested. So what will that look like for you can see for the recent 10 years return. So you at age 50, you invest 100K into it. Then it become a lifetime income. Looking at the last column, this number. So when you turn 65, right? You are looking at, you can take annually 76K a year for age 65, and it also grow over time, which is very nice. So that makes your retirement income, protecting the retirement income, keep up or even beat the inflation over the years. So when the client turn 80s, given the historical returns, we are looking at getting $443,000 a year just from this initial $100,000 investment. That's like over the time accumulated value will be for this 100K investment will be over 3 million, right? So like 30-fold growth. Yeah. So remember I talked about the high cost of living increase over the time. You are looking at 40K annually after like 30 years. So yeah, this can actually keep up with the high inflation, even like I assume 4% inflation also. Yeah. So yeah, all three are very good products and solutions for different kind of people's needs. So yeah, don't hesitate to go and talk to me or any CFT on the 9Fortune platform. So for a more customized, detailed consultation and recommendations, right? So moving forward, so yeah, so this I talk about, yeah, this is the FNG rating rates currently. And then finally, I'm going to talk about why now is a good time to invest into the fixed index annuity. So the first reason is this is actually the highest rate in recent years or over the entire of my career or some old folks' career. So part of the major reason is that because of the high inflation that we are facing in highest inflation in the last 40 years. So the Fed last year kind of have the fastest interest rate hike in 40 years as well to want to control the inflation. And the interest rate starting from 0 and all the way to 4.5% at the end of 2020. So this is actually the highest rate we ever seen since 2008, right? So that's also affected the rate on the FIA world, right? Because remember I talked about the inside mechanism, higher interest rate, meaning the insurance company have a higher budget to invest in those call options, meaning that you can buy more calls, which translate to higher participation rate. So you can see on the BC side, they actually did 4 rate increase in a row for last year. So every quarter they are raising the rate on their products. So initially, in the beginning of the year, we're looking at take this example, the participation rate is 110%, but at the end of year, it's become like 280%, almost like more than doubled, right? So, and also like for a charged version of the same index, the charge actually goes lower from the 1.5 to 0.95%. But well, the participation rate also goes higher, right? So yeah, so then people might think, oh, is it still worth waiting? Because the Fed might raise interest rate up to maybe twice this year as well. But probably not a good idea, right? Because actually the rate of the insurance company is more not look at the short end Fed rate. It's more looking at the 10 years US government treasury bond yield. So this bond yield is kind of floating around in the market. And actually it peaks in last October at 4.2%, right? Currently it's running at around 3.5%, right? Because that's the reason, because people are expecting a recession this year. So they are expecting the Fed gonna drop the rate a little bit to like fight for the recession and stimulate, go back to the stimulation mode, right? So that's why they are trading the inflation, the 10-year treasury yield low, as they see like this is coincide to the peak of the CPI number. So they are kind of expecting the Fed will lower the rate over this year, later half of this year. So actually, I think this current rate is probably the highest we in this interest rising cycle for the FI. So it's actually a good time to invest now, right? The second reason is actually a lot of insurance companies are running some limited time promotions, like say this Allianz ABC annuity products that I just showed before for the income focused scenario. So they're actually starting from today, they are running a promotion to bump up the initial pension protected income value bonus from 22% to 32%. That's a very big change, right? Immediately you get 10% the moment that you get invested. But this is a limited time extra bonus. It only lasts till April 3rd this year. So you need to catch up before it's gone, right? The third thing is actually, well, because of the current market conditions. So since the December and the January this year, the market sees some easing because of the CPI is kind of going down a little bit. People expect it already peaked and expect the Fed kind of gonna stop tightening. So the market actually have a good rebound of like 9% or so by this year, right? So it's actually a good time to think about taking your investment out of the stock market and get it into FIA for protected returns, because there's still the talk of the looming recession in this year. The probability is higher than 50%, and the market mood kind of could be changing over the night. Maybe one disaster earning from a big company will completely change the mood and go back to the bear market mode again, right? So we really need to take advantage of the recent market rebound and as a relief, and think about protecting your savings. Because last year we are talking about if you invest in NASDAQ or QQQ, NASDAQ 100 or SP 500, you are looking at 1 year performance of negative 30% and 32% and 18%. But well, so if you look at over the long term, in the history, you can see like even in the first 22 years of this century, we have two big market crash. One is the tech bubble in 2000 and another is the financial crisis. So we are talking about the worst year for NASDAQ is like down 40%, 41%, and SP 500 is 36%, and the max drawdown for the tech bubble for NASDAQ is 81%. That's wobbling 81%. Like you invest in $1,000 in it, and the end of the 2003, you probably only left $200. So are you able to afford this kind of drawdown in your retirement savings? Probably depend on your age. If you're still young, probably okay. But if you're reaching the retirement age, if I were you, I don't want to risk for a possible like soft landing and market rebound versus like a continued decrease in the market. So no one can tell, but it's actually the market goes down, continues going down this year is actually a real concern for a lot of folks or the financial analysts, right? Yeah, so that's all for my today's talk. So I will leave some time for Q&A sessions. So feel free to ask me any questions on the chat.
Thank you so much, Jeff. Thank you so much for such a wonderful presentation. So let's give Jeff a big hand. He prepared a lot for everyone to enjoy this wonderful presentation. I know a lot of the community not familiar with finance and insurance, so that's why Nine Fortune set up all these educational seminars for everyone to enjoy. I see many people here, many new people on the room. So if you have any questions, just write it down and we're gonna answer these questions accordingly. I take a few notes from Jeff's presentation. So accumulation phase and distribution phase. Basically, Jeff, when you say about accumulation phase, this is the part in our life that we need to pay attention, because the accumulation phase, it's from 25 to 65.
Right.
Basically, this time, you know, because we live by day, we don't pay attention to the time. We think that we're gonna be young forever. Mm-hmm. I remember in 2000, my HR pushed me to open my 401k, and I never thought that one day I'm gonna be 48 like today, right? So because we live by day, we think we're never gonna be old, but time goes so fast. So we need to take advantage of the accumulation phase for everyone here in this room. 25 to start saving for retirement. Most of us, we don't believe on financial services because we only believe the bank. We always believe CDs, we always believe checking accounts, we always believe about saving accounts with 0.001%. So now, Jeff gave us such a wonderful presentation with a lot of products providers. If you have any questions, just scan the QR code from Jeff here. He got a WeChat. I'm sure he have a 9 Fortunes QR code. He's gonna post it maybe for the next presentation.
Yeah.
And the distribution phase, that's the scary part, Jeff. The distribution phase, if we don't think about the accumulation phase, there's no distribution phase for anybody because Social Security, like you say, it's 20% cut, right? 20% cut, and the people who retire right now, so myself, I'm sure I'm not gonna have Social Security in my and our kids. So it's our time to educate our kids, the community, to make sure they understand retirement planning. I have a question for you, Jeff. So if somebody have a 401k, let's say right now, and they still active working for the company, say a 50-year-old person, he got 50,000 401k. Can he roll over this 50,000 to an annuity?
So if it's your current company 401k, so the answer is usually no, unless the company has some special in-plan conversion features, or you already become like 60, so there's option for 60 years old to roll over when you are still working. But also, as I said, there's another option you can put in those. You have personal IRA account maybe, and you can put in some of your non-qualified money into the FIA as well, right? Because nowadays people change job very frequently, especially in the Bay Area. So I never see one folks just work in one company for 30 years and don't change jobs. So most of the time I see a lot of people have a lot of like 10 401ks floating around without being managed. Yeah.
All right, thanks, Jeff. Because we're running out of time, I'm just gonna share a little bit my screen to share the group here, because I see many new people that they're not familiar with the website, 9 Fortune website. So I'm sharing my screen here. So if you're a new member in the 9 Fortune website, you have access to many good things in our platform. So just go to my 9fi.com and try to log into this website. Set up your password. So I'm gonna log in because I already set up my password. It's pretty simple. Just put your phone number, email, and they're gonna ask you to send your password and blah, blah, blah. You just set up your password. Once you have password, you can just log in. And once you log in, you have a lot of good things in this internal 9 Fortune website for yourself. So if you notice that we have many events through the week, right? And I'm gonna emphasize on the English seminars and Spanish seminar, like this coming Thursday. We will have a retirement planning for the Latino community in Spanish. So if you have a Latino friends, give your QR code, your poster, because every individual person in this Zoom have a specific QR code. So you have your own, and you have your own smart link that you can distribute this information to your social media. So when people they scan the QR code and they register, you will get 100 miles for every new person that scan the QR code. I don't know how many followers you have in your social media, but I remind you, if you got 1,100, you may have enough miles for a flight ticket of your choice. Another one, for this coming Saturday, you need to register to this event. Guno and myself, we're gonna share about 9 Fortunes platform, opportunity seminar, and we're gonna talk about how to build your financial house. And at the same time, for those members who wants to fast start, your new members, we're gonna talk about Faster, 9 Fortune Faster, our system. So register. We're gonna start at 10:30 to 3 p.m. We're gonna have lunch inside, so people can enjoy lunch as well and coffee in the morning. So it's gonna be a good event. So make sure you register. and share this poster to your social media, because eventually if somebody wants to listen to this presentation, that particular individual is going to become your member. And any information that we give to your new member, you will see it in your back office. So this is basically our website. Everyone have access to their own website. You can edit classifieds here in Spanish or English. You can edit, I think the company give you one classified a week, and you can do a new classified, just put any business information here, update it, and you can share it to your social media to promote any business from your clients. So this is our website. And a lot of people are not familiar with the 9 Fortunes app. We have a 9 Fortunes app. So if you notice right now on my screen, I got connected my cell phone with my screen. See, what you see right now is my cell phone. So on my cell phone, I can, does anybody get familiar with technology? I think everyone has to be very familiar with technology. If you don't, that's why we got 9 Fortunes. So you can get familiar with technology, because we're gonna give you education step by step. So here, it's very simple. Once you download the 9 Fortunes app, right, you scan this QR code and you can download the app, and you have access to a lot of seminars here through the app. So just go to classes, go to classes, and here you will have many seminars, and all these seminars are connected through Zoom. So if you just click on there, it will send you directly through this seminar. And we have many other seminars here. This one correlates with the website. So we have the Spanish seminar here. You can copy the smart link and share it to your social media. You can share this one as well. Because I have 3 new members already registered to this seminar. So you can just click on the poster, you will see it, a beautiful poster, right? And at the same time, you just go copy a smart link and just click copy, and then you paste it in your social media. And you can download the poster as well. Click download, and it goes into your files. So it's pretty simple. If you're not familiar with technology, just click until you get familiar. With that, I will say thank you, everyone. It's kind of late. We're running out of overtime to provide these financial services, and we thank you for such a wonderful presentation. I know a lot of us learn a lot, and we're gonna continue promoting Monday education and Tuesday education for the community. With that, I will say thank you, everyone. Have a wonderful night, and I'll see you Thursday for commercial lending and Saturday for 9 Fortunes opportunity seminar on Irvine. With that, thank you very much. Have a wonderful night.